Tushar Poddar from Goldman Sachs now joins us, Chief India Economist. Tushar, thank you so much for taking out time for us. Can you just first start by telling us that, will the economy see a cyclical recovery? Can you just tell us what do you expect in terms of upturn coming in 2016?
So we are already seeing signs of a cyclical recovery in the economy over the past few months. We're seeing demand indicators moving up, whether it's IP or auto sales, cement sales, consumer demand indicators as well are showing an uptick. So it is really a continuation of trends that we are already seeing. And the primary drivers are going to continue to be policy. Fiscal spending has been pretty significant in the first 6 months of this fiscal year. We've seen 125 basis points of rate cuts, which will gradually be transmitted through the system. And apart from that, if you get a significant wage increase due to the pay commission, that will add to the cyclical impulse in the economy. So it's domestic demand and it is policy-driven domestic demand. And the two sources of demand are the urban consumer and government capex. Those are the reasons why we're seeing a cyclical recovery or a cyclical upturn. It's a gradual one, but it is definitely an upturn that we're noticing in the activity data.
Do you agree that if the fiscal deficit is not allowed to slip, the boost from pay commission hike may not be that material?
Yeah, so that is an interesting question. I think it's going to be challenging for the government. We'll have to wait for the budget on how they square this circle of providing for a wage increase, providing for OROP, continuing to do capex and yet cut the deficit. It's not going to be easy. There are a couple of aces up the sleeve. One is the continuing increase in revenues that are coming from oil excise duties. Also, the disinvestment target is likely to be very low this year, and a lot of that can be pushed to next year. So you might see an increase in disinvestment and meeting those targets to fill the gap. And failing which, I think the government might be less ambitious on its fiscal consolidation path. So you might not see as aggressive a consolidation on the fisc simply to make sure that capital spending is not compromised on. So you're right, something has to give. And it might just be that it's the fiscal consolidation that might give in favor of having greater capital spending.
Do you think more than compulsion, the government should actively choose the part of slightly looser fiscal policy?
I think the path of fiscal consolidation should continue, but I don't think you have to be very aggressive in that path. So I think what we would like to see is that 3.9 deficit, if they meet it this year, continuing to be whittled down, and that medium-term path is continued towards a lower deficit. But if it means that you must stick to 3.5 and 40 basis point of reduction when the global environment is weak, when global demand is weak, then there might be some room. The alternative, as I said, is to increase your disinvestment targets. That is one way to meet the deficit targets and actually do something which is structurally beneficial for the economy.
Do you think that last when we chatted at the end of 2014 for an outlook of 2015, the drivers for economy in 2016 are much weaker? So what we underestimated in late 2014 was the drag on the external side. Nobody predicted that exports are going to be down 15 to 20% for the full year. So, we were optimistic of a cyclical upturn of some improvement in activity in 2015. And we did see some improvement in activity after the first quarter, which was, affected by the massive fiscal consolidation that the government did to meet its deficit targets for FY15. So this year, I think the drag from the external side was much more than expected. I don't see the same drag next year, partly because the base is low, partly because a lot of the commodity volume and price declines have already been factored in. And also we're seeing some improvement at the margin on the trade side. So the drag from the external side is less, and you've got 125 basis points of rate cuts in the bag this year, which you didn't have last year. So on both those fronts, I think there is an incremental stimulus in 2016 compared to what we had in 2015.
Right. Is it looking very tough for corporate India to grow earnings in FY17 given the very large external exposure and the demand globally seems to be very low?
Yeah, so I think these sectors which are highly indebted, and there are, the big capex sectors, utilities, materials, industrials, these are the ones which are still going to have challenges. And to the extent that they are externally exposed through energy prices, that's going to continue to remain an overhang on the sector, although not necessarily on each individual company. But there is a large segment of the universe which is unlevered, or everything related to the consumer, for instance, autos, IT, pharma, where the ability to spend and to borrow still remains. And I think that both credit demand as well as growth is likely to be driven by these sectors. And to the extent that the government spending, whether it's the pay commission wage hike or government capex, can help these sectors, that's also going to act as a fillip to their spending. I mean, half of the total debt in the economy is held by companies which comprise of less than 1% of total market cap of the broader index. So, it is highly concentrated, the debt levels.
Do you expect the Fed, whenever it hikes the rate, maybe now or 2016, it will be a significant driver for emerging markets one way or the other?
Yeah, I think one has to look at two aspects of the Fed rate hike. One is, to what extent does the Fed surprise market expectations, either on the hawkish side or the dovish side, and that is going to be more deterministic of capital flows rather than just a hike itself, which is well telegraphed and everybody knows about it. The second issue is what happens to the US yield curve. If it steepens or the 10-year moves faster than the short end, then that is going to put pressure on yield differentials globally and is more of a negative for emerging market assets, including India, simply because of the whittling down of the carry. So one has to look at those factors rather than just a Fed rate hike in determining what can happen to capital flows. And there will be some outflows, clearly, because of the shrinking of yield differentials. But one should not exaggerate that unless one answers the 2 points that I raised, which is, how much is the Fed different from market expectations, and what happens to the shape of the yield curve.
Do you expect 2016 for equity investors to be rewarding year rather than a pretty tough year?
I think we are expecting the Nifty to move up in line with earnings growth, and there is a fairly optimistic view on earnings growth, and our 12-month target on Nifty is 9,000. So for equity investors, it could well be a good year. Of course, one has to be in the right place. But overall, the macro is supportive of equity prices moving higher.
And the right place to be will be the domestic linked sectors.
Correct. Domestic sectors, those which benefit from the big public investments in infrastructure, those would be, areas which could see better prospects than the highly levered and the ones which are facing a slowdown in demand.